A very to the participants and more so for the esteemed speaker to the Companies Act and the RBI norms. The first webinar, which is to be conducted by Kochi a club of IIA after being inaugurated a couple of months back. And it's a pleasure to note that my dearest friend and brother in profession, CA Kamal Garg from Delhi, is a speaker. May I request our past chairman of Ernakulam branch, CA Srinivasan PR, to kindly welcome our speaker as well as other guests. Over to you, Srinivasan, sir.
Thank you so much, Deepa. First of all, hearty welcome to our dear speaker, CA Kamal Garg. I will start with a quick short introduction of Kamalji. CA Kamal Garg is a fellow member of ICAI, holds a first class BCom honors degree from the University of Delhi and a diploma in systems audit of ICAI. He is a registered insolvency professional with the IBBI and has completed the BRSR certification course and NISM social auditors examination. His professional roles include contributions to various committees of the Institute of Chartered Accountants of India, such as the Accounting Standards Board and Financial Reporting Review Group. An accomplished author, his works include IFRS and Ind AS concepts and applications and Insolvency and Bankruptcy Code, a ready reckoner. Kamal Garg has shared his experience widely, contributed to regulatory projects, and trained CBI inspectors in insolvency and bankruptcy laws, highlighting his impact in the fields of accounting and insolvency. And on a personal note, not just for me, but for many chartered accountants in and around India, I can proudly say he's a guru to many of us. And probably someone whom we can easily approach if we have any complications, any doubts to clear. He is perhaps one of the most approachable persons I have seen. Very hearty welcome to you, Kamalji. So happy to see you. And I'm sure today's session will be a true session of enlightenment and knowledge for all our participants here. I also take this opportunity to welcome each and every one of the participants. I'm sure that this session is going to be a memorable one, rich in knowledge and excellent deliberations. Thank you very much. Back to you, Deepa, madam.
Thank you, C. Srinivasan. Now, just on a lighter note, dear participants, so this is the Kamal Garg who writes all those books. Now, I think he has around almost 60 publications to his name. With these words, sir, the floor is all yours and we are very eagerly waiting to listen to you.
Deepa ma'am, for this welcome address. I am really overwhelmed and I can see Srinivasan sir. Srinivasan sir, the kind of welcome you have granted me, I'm really obliged, very warmth in your words. And I'm really glad that I'm addressing the audience today. So good evening, audience. And the kind of introduction is being given by Deepa ma'am and Srinivasan sir has made me much more responsible towards my speech because on one hand, Deepa ma'am is my elder sister also. So I need to be very cautious, otherwise she will reprimand me at the end. And on the other hand, I do have my big brother Srinivasan sir also. So I am surrounded by my relatives and they may be watching my speech as well. So before I share my screen and discuss the topics, I must ask you the very first, very frank and blunt question. How many of the listeners do believe that whatever internal audits they did was comprehensive? Normally, what is going on, generally, we do take the scope from the management and we serve them as per the scope. Or we will take the past year observations or past quarters observations and then we'll take some corrective actions or corrective reporting. In today's program, you will be finding several case studies, which are my personal experiences during the internal audits. And I would be asking you questions also. I would be glad if you can help me with your answers. And you will find all those case studies which I will be discussing are practical case studies from real world. Only thing is, I have removed the names of the clients. So you will get to know the practical flavor of those case studies in just next 2 minutes. I'm sharing my screen. Just confirm me once my screen is visible. Keep your notepad and pen ready because I'm going to ask you certain case studies also. And you will get to know how mistakes may take place during these internal audits under Companies Act and RBI norms. Deepa ma'am, is my screen visible?
Yeah,
Okay.
it is visible.
So, ladies and gentlemen, the topic given to me is companies that an RBI norms, commonly observed deficiencies in internal controls. You being professionals understand very well as to what is internal control. For the sake of repetition and reiteration, what is internal control? Internal control refers to a process which is designed and implemented by the company's management. Now, these words, designed and implemented themselves, are subjected to open challenge by the internal auditors. So, internal control refers to the process designed and implemented by the management, board of directors, and other personnel to provide reasonable assurance of achieving objectives in the following categories. So, three major objectives are focused during internal control assessment. Operations, that is their effectiveness and efficiency. Second is financial reporting, that is its reliability. And lastly, compliance. Compliance means the compliance with the applicable laws and regulations. So when we say deficiencies in internal controls, ideally I would say the layman, deficiency means the difference between what is done and what was supposed to be done. That's a very layman terminology of deficiency. Deficiency means the difference between what is done and what was supposed to be done. If I put it in a very theoretical side of meaning, deficiencies in internal control refers to the weaknesses or failures in design or operation of internal controls that could potentially prevent company from achieving its objectives. And these deficiencies again can be having three broad categories: deficiencies as to operations, deficiencies as to financial reporting, or third one is deficiency as to compliance. If I categorize these deficiencies, I will say there can be two major deficiencies in internal controls: design deficiency and operating deficiency. So what is design deficiency? A design deficiency occurs when a control necessary to meet the control objective is missing. So if control policy itself is not there, it is absent, it will result in design deficiency. Or when an existing control is not properly designed to address the identified risk. For example, if a company lacks procedures to ensure that all transactions are recorded in timely manner, this would be design deficiency. On the other hand, we have operating deficiency. What is operating deficiency? It is a deficiency that occurs when control is designed correctly. Control is designed correctly, but it does not operate as intended. Or the person responsible for performing the control lacks necessary authority or competence to execute it effectively. We will discuss several case studies on both these aspects. But yes, if I say as an example for operating deficiency, it may include, for example, if reconciliations are supposed to be done monthly, but are frequently delayed or skipped, this would be an operating deficiency. This is the ice-breaking theoretical discussion only. Now, having this ice-breaking theoretical discussion, let me move forward to practical experiences I had during internal audits. So we will start with Companies Act. The first experience I had is vis-a-vis borrowings, deficiencies in internal controls over borrowings. Just see the question very carefully. ABC Limited, a large construction company with a total borrowing of rupees 1,000 crores, obtained after special resolution approval under Section 181C. Now, what does Section 181C says? Section 181C says that if you are a public limited company and you wish to borrow more than the sum total of your paid up capital plus security stream account plus free reserves, then you have to obtain special resolution approval. So what is the question saying here? The company is a public company, ABC Limited. It's a large construction company with total borrowing of rupees 1,000 crore, and the loan was obtained after SR approval. SR means special resolution approval under Section 181C. The company was found to have significant deficiencies in its internal controls over the management of its loans during the internal audit in FY 2324. The audit revealed that the company failed to comply with the debt covenants associated with a rupees 300 crore term loan from a major bank, such as non-filing of quarterly stock statements, leading to triggering of a default clause. Additionally, the company did not have an adequate process for tracking interest rate changes, resulting in overpayments of rupees 5 crores in interest due to non-utilization of lower interest options. So these are the two major observations we had during internal audit. Now, so what were the issues identified? The issues identified were: number one, non-compliance with debt covenants, and number second, weak internal controls over borrowings. Now, when these issues were identified, as internal auditors, we have another requirement. to be on a suggestive side, to be on recommended side. So what we recommended as corrective actions? Number one, strengthen covenant monitoring. So we recommended to implement a system to monitor compliance with all debt covenants regularly, ensuring that any breaches are identified and addressed promptly. Number second, establish a borrowing management system. In my experience, most of the corporate houses are lagging in this borrowing management system. They do borrow just like anything, but we need to have some borrowing management system in place. So we recommended them to develop a comprehensive system for tracking loan terms, including interest rates and repayment schedules to optimize financial management and prevent overpayments. What was the overpayment here? The lower interest option was available, but the company failed to utilize it because they were not tracking the interest rate changes. And that's the reason we recommended them to have a borrowing management system. Then regular training. Provide ongoing training to the finance team on managing borrowings and ensuring compliance with loan agreements to avoid triggering default clauses. And lastly, external review. Engage an external consultant to review the company's borrowings practices and recommend improvements to internal control. So these were the suggestions made. Now, don't be happy with this case study. Let me ask you a question on this forefront. I'm skipping this clip. I will come back to this clip. To discuss that clip, I need to have the fair idea of your understanding on share application money. I give you 2 minutes. Have a look on this question, and please do tell me if this question appears before you as a real forefront, what will be your observations as an internal auditor? So I place the question before the house. The question says, the company's RST Private Limited, one extract is there from the balance sheet of RST Private Limited about equity and liabilities. The extract says the company received share application money on 15 January 2023 through normal banking channels. And this money which was received on 15 January 23 was outstanding as on 31st March 2023, and it continued to remain outstanding without any allotment, without any refund, even on 31st March 2024. I give you 2 minutes, give a time to yourself, and please tell me what will be your observations as internal auditor. So you may use chat box to answer. What will be your observations on this forefront as internal auditors? Yes, any answers? I'm waiting for the answers, people. I would be glad if you can help me with the answers. As internal auditors, what you will do?
If anyone raise their hands, I can allow unmute to make conversation, or you can drop a chat questions there or answers.
So this is one of the area where I found that internal audit reports are not looking forward to on this aspect of share application money. Let me brief you what is happening here. Your attention is invited to rule number 2, sub-rule number 1, clause number C, item number 7 of company's acceptance of deposit rules 2014. I repeat the rule number 2, 1C, 7. In short, as a simple word, company's acceptance of deposit rules. Now, what these rules are telling, these rules are saying that if a company has received share application money, then the share application money shall be allotted within 60 days of its receipt. If the money is not so allotted towards share capital, then it needs to be refunded. Within next 15 days. So overall, we have a 75 days of window. Now the rule further says, if the money is not so refunded, it will be deemed as deposit. Now, the very moment it will be deemed as deposit, the company needs to comply with the provisions contained in section number 73 to section number 76 regarding deposits. Now, if you see this question very minutely, the company received the money on 15 January 2023. The 75 days have expired as on 31st March 2023. That means immediately on 1st April 2023, this 1 crore rupees, that is 100 lakh rupees, became deemed deposits. As internal auditors, we need to advise the client that this is deemed deposit. you are in contravention of section 73 and hence corrective actions need to be taken. This is the first observation in this question. Can you please see any other observation also there? First observation is deemed deposits, which is in contravention of section 73. Any other observation which you can make out? So the other observation here is, I can give you the hint, then you apply your wisdom and tell me the answer. The other observation here is disqualification of directors of company. Can you see whether any director's disqualification is coming up in this question? So you may recall in Companies Act we have section number 164 subsection 2. I placed this section before you. Section number 164 subsection 2 states that if a company has defaulted in annual filing for 3 continuous years, or the company has defaulted in repayment of deposits or interest thereon for a period of more than equal to 1 year from due date, then the directors will be disqualified for next 5 years. Just see this chart, it will be helpful. Section number 164 subsection 2 states that any company other than the government company which has made defaults in filing of annual financial statements or annual returns for 3 continuous financial years, or has made defaults in repayment of deposits or interest thereon, debentures or interest thereon, dividend for more than equal to 1 year from due date, then directors of such company cannot be appointed or reappointed as directors of such company or any other company for next 5 years. So because of this deemed deposits not being refunded for a period of more than equal to 1 year from the due date, that is 31st March 2023 was the due date, but you have not refunded it even as on date, that is 31st March 24. The directors are also subjected to disqualification under section 164(2). Just see what is the dangerous observation. And when we were auditing this company as internal auditors, we gave these 2 observations, and there was a kind of big hue and cry situation because directors are disqualified under section 164(2), and this is not the end. We have section number 167. Section number 167 says there will be automatic vacation of office once you are disqualified under section number 164. So that means the company was functioning despite directors were disqualified. And as internal auditors, it is our duty to limelight this kind of an observation and help the clients to overcome this kind of contravention. I believe this case study is clear to each one of you. So in this question, as internal auditors, 2 observations were pertinent. One is contravention of deposit rules because of the deemed deposits scenario, and second is directors disqualification. So we have to be careful on this forefront. Now let me share with you this case study which I skipped. I'm going back. So just see what happened in this case study. Company is DF Limited, a mid-sized manufacturing company with a turnover of rupees 600 crores, had accepted rupees 50 crores in public deposits without adhering to the provisions of section 73 of Companies Act 2013. The company failed, but we observed the company failed to issue proper deposit receipts, did not maintain the required liquid assets, and did not file the necessary returns like DPT3 form with registrar of companies. Additionally, the company did not maintain register of depositors, leading to discrepancies in the records. So these were the observations during internal audit. So what are the issues identified? Number 1, non-compliance with section number 73. The company's failure to comply with the provisions related to acceptance of deposit resulted in regulatory breaches and potential penalties. And second observation is weak internal controls over deposits. The absence of proper system for managing and recording deposits led to significant operational risk and non-compliance. So what we advise them? Corrective actions. Implement a deposit management system. So we advise them to introduce a robust system for managing deposits, including the issuance of deposit receipts, maintenance of required liquid assets, and filing of returns with ROC. Secondly, maintain register of depositors. Ensure that a comprehensive and accurate register of depositors is maintained as required under the Companies Act to avoid discrepancies in the records. Then regular audits. Conduct regular internal audits to ensure compliance with all statutory requirements related to acceptance of deposits, thereby reducing the risk of regulatory penalties. And immediate rectification. Rectify any discrepancies in deposit records and file overdue returns with ROC to bring the company into compliance with section 73 of the Companies Act. By the way, let me ask you one question. Under Companies Act, there is a provision that if you received amount of loan from your director, if you receive amount of loan from your director, then it is considered as exempted deposit if such director gives you a declaration in writing that these are my own funds and not borrowed funds. That is what the deposit rule says. Similarly, deposit rules also state that a private company can accept deposits from the shareholders to the extent of 100% of its paid up share capital. Now, my question to the House is, if company name is RST Private Limited and all of us are shareholders of RST Private Limited, the rule says we shareholders can give loan to the company RST Private Limited, but to the extent of 100% of paid up capital of RST Private Limited. Question for the House is, the way company seeks a declaration from the directors that the loan amount is from his own funds and not from the borrowed funds, whether the same declaration is required even from the shareholders by the company, yes or no? If we are the shareholders and we are giving loan to the company, whether we also need to give the declaration that these are our own funds and not the borrowed funds? Please mark it. It is a yes. As per company's acceptance of deposit rules, rule number 10, 11, 12, as shareholders, although the deposits are exempted, but still we have to give the declaration that yes, these are our own funds and not the borrowed funds. So this declaration of own funding and not borrowed funding is required even by the shareholders. I believe this point is clear to each one of you. Let us proceed further. Case study number 3. Deficiencies in internal controls regarding intercorporate investments. So for intercorporate investments, we have section number 186. We'll do a numerical case study also, but before that, let us have this question number 3. GHI Limited, a diversified conglomerate with investments totaling rupees 400 crores in various subsidiaries and associates companies, was found to have serious deficiencies in its internal controls over intercorporate investments. The internal audit for FY 2324 revealed that the company made investment of rupees 100 crores in a subsidiary without obtaining prior board approval, violating section number 186 of Companies Act. So I may recall you, section 186 says that if you're going to make intercorporate investments in any company, subsidiary, associates, or any third-party company, board approval is required, and that too unanimous approval. So there must be 100% voting in favor to give this kind of loan. And the internal audit here revealed that this kind of approval was not obtained. Additionally, the company failed to maintain the adequate records of these investments, leading to discrepancy of rupees 25 crores in the financial statements. So the financial statements were not reflecting deposits in reconciliation with the records of intercorporate investments. So what were the issues identified? Number 1, non-compliance with section number 186. And number 2 is weak record keeping. So what we advised? First, obtain retrospective approvals. So immediately seek retrospective board approval for rupees 100 crore investment to comply with section 186. Number 2, implement an investment tracking system. That is to develop a robust system to track and manage all intercorporate investments, ensuring that approvals and records are maintained in accordance with statutory requirements. Number 3, regular board oversight. Ensure that all significant investments are reviewed and approved by the board with clear documentation, for example, minutes of the decision-making process. And lastly, enhance record keeping. Improve the accuracy and completeness of investment records, ensuring that all investments are accurately reflected in company's financial statement. I place before the House one question. Consider this balance sheet. This balance sheet pertains to the company Maxwell Limited. The particulars and the amounts are given to you. Equity share capital, calls outstanding, preference share capital, share application money, securities VM account, capital redemption reserve, fixed assets revaluation reserve, general reserve, P&L account, credit balance, and dividend equalization reserve. The question further says, company proposes to acquire 3 lakh equity shares of rupees 10 each of PQR Limited. It also intends to execute a corporate guarantee for rupees 25 lakhs in favor of Goodwill Limited, a wholly owned subsidiary company, and a corporate loan of rupees 50 lakhs to ABC Limited. State the legal requirements to be complied with to give effect to our proposals. So I need your answers. I'm hiding this block. This is the basic data. You can take a note of these proposals. So as internal auditors, what legal requirements you will be vouching vis-a-vis Maxwell Limited? Yes, any answer? I can give you the hint. Section number 186 compliance. Let me recall you, we have section number 186, and section number 186 says that if you are making intercorporate investments in subsidiary, then such investments are exempted for the purpose of obtaining special resolution approval. This is point number 1. Section 186 also says that if you are making intercorporate investments in other than subsidiary companies, when I say intercorporate investments, it will include loan transactions also. Now, what the law says in section 186, if the amount of investment to be made, whether securities transaction or whether loan transaction, if the amount involved in such transaction is more than the highest of 100% of the see the limits, free reserves and securities free account, or 60% of paid up capital plus free reserves plus securities free account, then you have to obtain special resolution approval. If special resolution approval is not obtained, then it will be a contravention of section 186, and then obviously penalties may follow. So with this very background, please try to calculate whether in this question special resolution approval is required or not vis-a-vis these two proposals. Okay, do one thing. I will show you the entire calculation. Just tell me from this question, what is the total amount of free reserves? Total amount of free reserves. What is the total amount of free reserves? Is any answer? Total amount of free reserves? No answer? Let me tell you what the mistake people commit over here. I got one chat answer. Deepa ma'am gave the answer as 48. Okay. Let me see in Q&A. I got one answer in Q&A as 52 lakhs. Okay. How many of you have included P&L account credit balance in free reserves? And those of you who have included P&L account credit balance in free reserve, that is the blunder we have committed. Please understand, P&L account credit balance is a surplus, not a free reserve. In fact, I should correct myself. P&L account credit balance is not a reserve at all, because this amount is yet to be appropriated to reserves. This amount is yet to be appropriated to reserves. So unless and until you will transfer the amount from P&L to reserves, they cannot have the character of reserves. And that's why whenever you complete free reserves, P&L account will never be included. For this purpose, you may refer section number 2, clause number 43. Section number 2, clause 43 of company that says free reserves are such reserves. Free reserves are such reserves which are available for distribution or dividend. So the words used are such reserves. That means for a reserve to be called as free reserve, the item must be a reserve itself. P&L account credit balance is not a reserve, it's a surplus. So just see the calculation part. This is the calculation. We have paid up capital, we have sum total of securities free account and free reserve. Just see this red P&L. This red means we have not included it. So total is 50. Then 60% of paid up capital plus free reserves plus securities free account 78. 100% of free reserves plus securities free account 50. Higher of these two 78. Now what is the proposal? The proposal is to invest in equity shares of PQR Limited, rupees 30 lakhs. Corporate guarantee to be given to wholly owned subsidiary, it is exempted, so it will not be counted. Then corporate loan to ABC Limited 50. total is 80 lakhs. This 80 lakhs is more than rupees 78 lakhs, and hence to make this investment of 80 lakhs, we need to have special resolution approval. So I can always say any amount which will go beyond 78 will be requiring the SR approval. In this question, the major learning was the correct computation of free reserves. So please always remember, by virtue of section number 2, clause number 43 of Companies Act, P&L credit balance is a surplus and is not classifiable as reserves, and hence it is also not classifiable as free reserves. I believe this question is clear to each one of you. Now moving ahead, other case study, number 4. This is also a very good case study, and maybe it is very much in plenty in industry, especially those industries where there is an export or import business. So just see the observation part. JKL Limited, an export-oriented company with revenues of rupees 1,200 crores, borrowed $50 million, equivalent to rupees 375 crores, through a foreign currency loan to finance its expansion plans. The internal audit in FY 2324 revealed that the company failed to hedge its foreign currency exposure, resulting in foreign exchange loss of rupees 30 crores due to adverse currency fluctuation. Additionally, the company did not comply with RBI regulations regarding ECB, external commercial borrowings framework, leading to potential penalties. So you know very well, whenever we borrow from outside world, that is beyond Indian territory, ECB norms are applicable. So in this question, what is the observation? ECB norms are contravened, and the company could have saved a lot of amount towards forex loss if hedging was adopted. Hedging was not adopted. In this very case, what will happen? In this very case, the observations identified will be inadequate hedging. The company's failure to hedge its foreign currency exposure resulted in significant financial losses due to currency fluctuations. And then non-compliance with ECB regulations. The lack of compliance with RBI's ECB guidelines exposed the company to regulatory risk and potential penalties. Now, what are the corrective actions? So we advise them to implement hedging strategy. We advise them to have regular compliance reviews, especially for RBI's ECB guidelines. We advise them to have board level oversight on regular basis so that the clear understanding of associated risks are underlined. And then we also advise them to have a training on forex management so that whatever treasury department they are having, they could have the options exploration on hedging and other kinds of arbitrage opportunities. Let me see something is there in Q&A. So in Q&A, there is a statement, please share some of the private company case study also. I would suggest whatever case studies we have covered till now are also applicable to private companies. So no difference is there as of now, except for the borrowing wala. So except for this question, I'm going back for a while. This question is meant only for public company because section 181C is applicable only to public companies. Balance case studies, that is this case study number 2, this case study number 3, and this case study number 4. All these case studies are also applicable to private companies. So no difference is there between public and private companies regarding these 4 case studies and one question which we discussed as assessment. Now case study number 5. This case study is also applicable to private companies. So no difference. So case study number 5 is about inadequate internal financial controls or financial reporting. So the company is XYZ Limited, a listed company, and the question will remain same, even if it will be private company. So no difference. Private, public, both are same as far as case study number 5 is concerned. XYZ Limited, or I can, for the sake of convenience, I can write like this also, or RST Private Limited. Both way, it doesn't make any difference. XYZ Limited, a public listed company, or RST Private Limited, with an annual turnover of rupees 1,200 crores, faced an internal audit in FY 2324 that revealed significant deficiencies in its internal financial controls. The audit found that company's process for recognizing revenue from long-term contracts was flawed, as it used percentage of completion method instead of point of time method, leading to an overstatement of revenue by rupees 75 crores. Additionally, there were lapses in reconciliation of bank statements, resulting in discrepancies amounting to rupees 10 crores that went unnoticed for several months. Can you please tell me when we have to use POT method instead of POC method? Please take a note. Percentage of completion method is not an automatic method. Certain conditions need to be fulfilled. Whether it is AS or Ind AS, certain conditions are required to be fulfilled. For example, if the contract says that, you will be able to cancel the contract. You will be able to cancel the contract until the construction is completed and house is delivered to you. If the contract says that the customer or the home buyer has the right to cancel the contract, until the house delivery takes place, then POC method cannot be applied. Only POT method can be applied. Now, what this company did, in order to inflate the revenue, they used POC method rather POT method. So this was one of the notice of internal audit. And so what were the issues identified? Number one, weak internal financial controls. The company's revenue recognition practices were inconsistent with applicable accounting standard, leading to inaccurate financial reporting. And then is non-compliance with Companies Act. The lack of timely bank reconciliations and inadequate oversight violated section number 134(5)(e) of Companies Act, which requires directors to ensure the adequacy and operating effectiveness of internal financial controls. However, please take a note, this section 134(5)(e) is applicable to only listed companies. So for private companies, this is not that much relevant. For private companies, this contravention of AS is only applicable. So what the advice was given to them? Advice number one, standardize revenue recognition. So revise the revenue recognition policy to align with the Ind AS. I am assuming that Ind AS were applicable, which could correct the rupees 75 crores of overstatement. Enhance reconciliation processes. Implement a monthly reconciliation process for all bank accounts to promptly identify and rectify discrepancies. This could have prevented rupees 10 crores discrepancy from going unnoticed. Strengthen oversight. Establish a committee to oversee the effectiveness of internal financial controls. And lastly, training and development. You will find training and development is quite common to all the corrective actions which we always advised. Next case study. Again, I would say this case study is common to public companies as well as private companies, doesn't make any difference. So case study number 6. The company is ABC Limited, a family-owned business. In India, majority companies are of this nature, family-owned businesses. With a turnover of 500 crores, was found to have engaged in multiple related party transactions during FY 2324 without proper approval from the board of directors or audit committee. The value of these RPTs was rupees 50 crores and they were not disclosed in financial statement. Additionally, the company did not maintain a proper register of contracts as required under section 189 of Companies Act 2013. The RPTs included purchase raw material from one of the firm in which director was interested, leasing of director's property for office space at monthly rent, which is not at arm's length price. ALP means arm's length price, etc. You know, in these kind of companies, which are family-owned companies, generally the promoters of the company, they do believe that company and the promoters are one and the same thing. Promoters generally don't digest this concept of separate legal entities. So what they will do, they will simply do the transactions with their own relatives or own parties which are related, just like that. They will simply cut a check, they will simply do the NEFT, RTGS, and this leads to contravention. So a sense of awareness is required to be created amongst the promoters that now you are a corporate house and you need to honor and respect the separate legal entity concept. But generally, it is not being inculcated of late in India. And that's why the RPTs are on a very high risk note for internal audits. So what were the issues identified? Number one, non-compliance with RPT regulations. The failure to obtain necessary approvals and disclose RPTs violated section number 188 and 189 of the Act. And then weak internal controls over RPTs. The absence of a formal process for monitoring and approving RPTs resulted in a lack of transparency. Before I move to the next clip, I need to ask a question to the House. We are referring section 189 here. Can you please tell me what is the amount limit? What is the amount limit beyond which we need to maintain register for these RPTs? Is any amount prescribed by the law that if the contract with party related is beyond this amount, then you have to maintain a register for the same? Is any amount prescribed? You may take a note, rupees 5 lakhs. So beyond rupees 5 lakhs, if any RPT is there, singly or aggregatedly, then you have to maintain the register of contracts with them. Can you please tell me, and I would request do not search on Google, can you please tell me what are those related party transactions? I asked the question and I'm requesting please do not search on Google. Can you please tell me what are those related party transactions which are not listed in section 188 of Companies Act, but are listed as RPTs under accounting standards or Ind AS? Can you please name one or two transactions? I repeat my question. My question is, what are those transactions which are not considered related party transactions under section 188 of Companies Act, but are considered related party transactions under under accounting standard 18 or Ind AS 24 as the case may be? Any answer? Please take a note. There are two transactions. Transaction number one, loan transaction. So if there is a loan transaction between parties related, it is not a RPT under section 188, but is RPT under applicable accounting standards. Second is guarantee transaction. If there is a guarantee transaction, like holding company gave a guarantee to subsidiary company, so this guarantee transaction is not a RPT under section 188, but is a RPT under applicable accounting standards. So when I say applicable accounting standards, it could be either accounting standard 18 or Ind AS 24. I believe the points are clear to each one of you. So now if I come back, what were the suggestions we made before them? Number one, obtain approvals for RPT, because approvals were not obtained, so you have to obtain approvals either from the audit committee or board as the case may be. Disclose RPTs so that the legal requirements of not only the Companies Act but AS or Ind AS also complied with. Then maintain RPT register as per section 189, and lastly, implement an RPT policy. So we advise them to develop and implement a related party transition policy with clear guidelines on approval processes and disclosure requirements. So you know what will happen? This RPT policy will serve as SOP, standard operating procedure for RPT, and this will be helpful to the corporate house staff also how to move ahead with the RPT. Consider this question and take a minute to answer this one. RST Private Limited is a real estate developer and is developing a township in Jabalpur. RST Private Limited entered into a contract with Mr. R, its director, whereby he will be providing rent-free space in his building at Jabalpur for setting up administrative office of the company. The building space will be provided for a period of 50 years with substantial control being vested with the company and only protective rights with Mr. R. In lieu of such space, Mr. R will be provided car by the company for his use until such arrangement is in existence. Question is, comment as internal auditor. So if this is the fact before you, what will be your observation as internal auditor? Any answer? I must remind you, when I started my speech, I told you all these case studies are from real world. Only the names of clients have changed. So what is your observation as internal auditor? I must again remind you that this observation is in respect of Companies Act. Any answer? So if my elder sister Deepa ma'am or my big brother Srinivasan sir is there, I must ask the questions to them also. Any view as internal auditors on this case study? Let me give you the hint. Okay, I can see Deepa ma'am. So Deepa ma'am, I'm sorry for the audacity, but I am taking this liberty to ask you this question. What is your observation? Normally, people will say only one thing. It is RPT. It is RPT. That is not a botheration. We have already covered RPT. That's why I deliberately took up this question after discussion of RPT. Can you see something beyond RPT in this question? And that is what internal auditors must be diligent about. I take a note of this question and I quote a section also, section number 192. Section number 192 deals with acquisition of assets from directors by the company or vice versa in non-cash mode. Now, section number 192 says that, section number 192 says that if you are acquiring an asset, from your director in non-cash consideration, then you need to check whether general approval from shareholders has been taken or not, whether valuation report has been taken or not. Now, if you see, this is the long-term lease, 50 years, and it's a kind of acquisition of the asset, that is office space in the building. So as internal auditors, we need to check whether for acquisition of this rent-free space and provision of car in lieu thereof to the director needs compliance of section 192 or not. If the company has not complied with the requirements of section 192, it is a negative observation. I believe the point is clear. So in this question, besides section 188 RPT, we also need to check up section number 192, acquisition of assets by the company from director or by the director from the company in non-cash transaction. So here no cash is exchanged. Rather, it's a kind of barter system. So in that very sense, section number 192 needs a compliance. And I believe you must have understood as internal auditors that things are not that much easy as internal auditors as it is perceived. So please ask your clients and check with your clients also whether they are having any SOP or not regarding non-cash acquisitions by the company from directors or vice versa. Case study number 7. Just give me a moment. Yes, GHI Limited, again I will reiterate, this question is common to both public as well as private companies, no difference. GHI Limited, a company with 1,200 employees, was found to have deficiencies in its management of employee benefits, particularly in calculation and provision for gratuity. An internal audit for FY 2324 revealed that the company underprovided for gratuity liabilities by Rs 5 crores due to incorrect actuarial assumptions. Additionally, the company did not have a proper system in place to verify accuracy of employee records, leading to discrepancies in calculation of benefits for over 200 employees. So what happened in this case, these 200 employees were contractual labor. These 200 employees were contractual labor. And what the company committed a mistake is, these 200 employees were not captured as employees for the purpose of gratuity provision and actuarial assumptions. That was the discrepancy. If you refer AS or Ind AS, AS 15 or Ind AS 19, even contractual labor is covered for the purpose of employee benefits. The same goes with the payment of gratuity act also. So these 200 employees were missed, and the company was having the ground that these are not my employees, these are the contractual employees. So this could be emotionally correct statement, but legally and logically, this is incorrect statement. These are also your employees. So what were the issues identified? Inaccurate provisioning, the under provisioning of Rs 5 crores for gratuity liabilities indicated weak internal controls or financial reporting, and then non-compliance of Companies Act. The deficiencies in employee records management violated Section 134 of Companies Act, which requires the preparation of accurate financial statements. So what were the suggestions made to them? Number 1, recalculate gratuity liabilities. Number 2, enhance employee records management to ensure accuracy of benefit calculations. Then regular audits, conduct semi-annual audits of employee benefit provisions to ensure compliance with Companies Act 2013 and avoid under provisioning in the future. Then employee training, as usual, common point of training. You will find training point in all the observations. Next question, case study number 8. Again, this question is common to public companies as well as private company, no difference at all. UVW Limited, a mid-sized manufacturing company with annual revenues of rupees 800 crores, was found to have deficiencies in its board meeting processes during an internal audit. The audit revealed that company failed to hold minimum number of board meetings under Section 173 of the Companies Act during FY 2324. Additionally, the minutes of the meetings that were held were not properly recorded, with critical decisions regarding rupees 200 crores capital investment project not being documented. So what happened here, this rupees 200 crores was given as a loan to one of the subsidiary company, which was the wholly owned subsidiary company. The company UVW Limited was of the view, because this 200 crores of investment in wholly owned subsidiary is exempted from Section 186. It must not be recorded in minute books. I'm sorry. Even if this transaction is exempted, still it needs to be recorded in the minute books. So what were the issues identified? Number one, non-compliance of Companies Act, the failure to hold required number of board meetings. Minimum 4 board meetings are required per year, and improper recording of minutes violated section number 173 and 118. Section number 173 deals with frequency of board meetings, and 118 deals with recording of minutes. Weak corporate governance. The lack of proper documentation of board decisions indicated weakness in corporate governance and oversight. If board meetings are not properly held and minutes are not properly recorded, it's the contravention of secretarial standards also. And this will result in appropriate penalties as per ROC adjudication. So what were the suggestions made? Suggestion number one, schedule additional board meetings so that whatever lapse in gap was there, that could be covered up. So immediately schedule and conduct the required number of board meetings to comply section 173. Proper documentation of minutes. Ensure that all board meetings are properly documented with detailed minutes recorded for significant decisions, including rupees 200 crores capital investment project. Strengthen corporate governance practices. Review and improve corporate governance practices, including ensuring that all statutory requirements about board meetings are met. Regular compliance reviews, that is, conduct regular reviews of board meeting processes to ensure compliance of Companies Act. CSR obligations. Again, this question is common to both public as well as private companies. In this question, what happened, I will read the question in a while. You may recall on 22nd January 2021, CSR rules were amended. Most of the companies, somehow, I don't know why, they were not diligent enough to comply with these rules. Let me share certain elements over here to understand. XYZ Limited, a large pharmaceutical company with a net profit of rupees 250 crores in FY 2223, is required under Section 135 of the Companies Act to spend at least 2% of its average net profits of last 3 years on CSR activities. This amounts to 5 crores for FY 2324. The company had previously complied with its CSR obligations, but faced challenges in the latest financial year due to changes in regulatory landscape following the MCA CSR amendment rules, which were notified on 22nd January 2021. Now, these amendments were notified, and because these amendments were not followed, following issues were identified. All these number 1 to 4, all these are those observations or issues which are because of amendment rules not complied with by the company. Issue number 1, underutilization of CSR funds. So what we found, XYZ Limited spent only 2 crores out of 5 crores mandated CSR budget by the end of FY 2324. The unspent amount of rupees 3 crores was not transferred to a designated fund as required by amended rules. Second observation was non-compliance with CSR reporting requirements. The company's CSR policy was not updated to align with MCA CSR Amendment Rules 2021. The board's annual report did not include the required disclosures about CSR activities, including details of composition of CSR committee, projects approved, and reasons for unspent CSR amount. Number third issue was failure to create an impact assessment report. You may recall we have rule number 8 of CSR amendment rules. And this rule say that if there is a project falling into CSR domain and the outlay on that CSR project is more than rupees 1 crore, you need to have CSR impact assessment report. So in this case, the company never obtained such kind of impact assessment report. So as per the amended rules, XYZ Limited was required to conduct an impact assessment of CSR projects where the outlay exceeded rupees 1 crore. The company failed to conduct and disclose such an assessment for its flagship CSR project, which had a budget of rupees 1.5 crore. This is missing in most of the companies. I must tell you, this CSR impact assessment is a good professional opportunity also. Then improper transfer of unspent CSR funds. The unspent CSR amount of rupees 3 crores was neither transferred to a specified fund as mandated by MCA rules such as PM Care Fund, nor carried forward for ongoing projects. So this violation can also lead to some penalties and further legal scrutiny. So what we suggested them, immediate compliance with unspent CSR fund requirement, either transfer to the special fund and take the necessary course of action, update the CSR policy, obtain impact assessment report, and this is something important, number 4, which I believe is a professional opportunity also, CSR compliance framework. Establish a robust monitoring framework to ensure timely execution of CSR activities and compliance with statutory requirements. This includes regular reviews by CSR committee and the board to track the progress of CSR projects and fund utilization. As professionals, you can advise the companies on drafting of this compliance framework, popularly called as CSR SOP. So this completes the Companies Act common observations as far as the deficiencies in internal controls were concerned. I will stop here. Should you have any question on Companies Act vis-a-vis deficiencies in internal controls, you may ask me. I will be happy to answer. So first segment, that is Companies Act, is over. We will move to RBI norms in a while. Meanwhile, I would be happy to answer your queries. So I presume there is no query because nothing is there in chat box.
Kamalji, can we just hold for 30 seconds so that in case somebody wants to ask, we just give them
Surely.
basic time. Dear participants, in case you have any queries, please feel free to raise a question on the chat box or on the Q&A box.
I can see one point over here. At the end of meeting, please share the presentation. So yes, I will send the presentation Deepa ma'am, and then they will look after. And I would suggest also, once you get this presentation, now all these case studies can help you as a checklist for further and future internal audits. So let us commence with the RBI norms. I
Yes,
believe there is
let's
no
please
query on
continue.
company. I am being told that Kerala is the land of NBFCs. And because Kerala is the land of NBFCs, I believe this RBI norm could be very close to your heart, and you will get to know the non-compliances, which are very common and of late are missed out during the internal audit. So again, the same way, we will discuss case studies one by one. So case study number 1 regarding lax loan approval processes. So XYZ NBFC specializes in providing personal loans. In financial year 2324, it disbursed approximately 50,000 loans, totaling 500 crores. During an internal audit, it was found that 10% of these loans worth 50 crores were approved without adequate verification of customers' credit worthiness. Additionally, it was discovered that 20% of these borrowers had a credit score below 600, significantly increasing the risk of default. The audit also revealed that for 3,000 loans, 6% total, the KYC process was not adequately followed, leading to non-compliance with RBI norms. Now, when we say KYC, one of the KYC requirement is there in PMLA also, because NBFCs are regulated, reported entities. So this was the observation which we had during the internal audit of one of the NBFC. So what were the issues identified? Number 1, weak internal controls. The automated system failed to correctly assess the credit risk, resulting in a substantial portion of portfolio becoming high risk. And second was non-compliance with RBI norms. KYC processes were skipped for loans totaling rupees 30 crores, violating RBI's regulatory requirements. So what were the suggestions made? Strengthen credit assessment. So we suggested them to introduce a comprehensive credit scoring model and set a minimum credit score threshold of 650. This would have potentially avoided 20% of the loans turning high risk. Then we also suggested them to enhance the KYC processes. We suggested to implement mandatory KYC checks for all loans. This could have prevented the non-compliance in 3,000 loans worth 30 crores. Then periodic review, conduct quarterly audits of the loan approval process to ensure adherence to RBI norms and internal credit policies. And lastly, the common point, training and awareness. I would suggest, especially for NBFCs, there must be regular ongoing training, because the way in recent past RBI is coming up with so many circulars and directions, the things are evolving day by day. So proper regular training is a must for NBFCs. Number 2 case study, inadequate capital adequacy management. ABC Finance Limited, an NBFC, reported a capital adequacy ratio of 16% in its quarterly submission to RBI for the Q3 of financial year 2324. However, during the internal audit, it was discovered that actual CAR was only 13.5%. The discrepancy occurred because the financial model used to calculate CAR was outdated and did not reflect the new risk weights introduced by RBI. The difference of 2.5%, how this 2.5% is coming? 16 minus 13.5 translates to a shortfall of rupees 100 crores in capital adequacy for a total asset base of rupees 4,000 crores. So what were the issues identified? Number 1, weak internal controls. The financial model used was not updated in line with recent regulatory changes, leading to incorrect CAR reporting. And number second is non-compliance with RBI norms. The NBFC could face penalties and loss of credibility due to incorrect reporting of key financial metric. Key financial metric here means CAR. So what were the suggestions made? Suggestion number one, update financial models. So immediately revise the financial model to reflect the updated risk weights. This adjustment would correct the CAR to 13.5%, aligning with RBI norms. Internal review mechanism, introduce a monthly review process to verify CAR calculations before they are reported to RBI, ensuring a discrepancy of 100 crore does not reoccur. Regular training and then external audit. That is the common point in most of the observations. Next case study, efficient IT security controls. DF NBFC experienced a data breach in March 2024. You know very well that in NBFCs there is a customer interface and a lot of data is there with NBFC. So in this question, the same is being captured. DF NBFC experienced a data breach in March 2024 where the personal and financial information of 10,000 customers was compromised. The internal audit revealed that NBFC's IT system, which handles rupees 2,000 crores in customer assets, was running an outdated software and encryption protocols were not properly implemented. The estimated financial impact of the breach, including fines, legal cost, and loss of business, was 50 crore rupees. The audit also highlighted non-compliance with RBI's cybersecurity framework, which mandates strict data protection measures. In my experience, what I observed, there are some NBFCs who are not even aware that there is any cybersecurity framework issued by RBI. So lack of awareness also is the cause of suffering. So what were the issues identified? Number one, weak IT controls. The use of outdated software and lack of encryption made the NBFC vulnerable to cyber attacks, leading to exposure of data worth potentially rupees 50 crores. Non-compliance with RBI norms. Failure to adhere to RBI's cybersecurity guidelines could result in further penalties and a severe loss of customer trust. Before I proceed further, let me discuss this corrective action also, then I will ask you a general question. So what were the suggestions made? Upgrade IT infrastructure. So we were suggesting them to upgrade infrastructure. So invest 10 crores in upgrading IT systems and implementing advanced encryption technologies. This could have mitigated rupees 50 crores of loss due to breach. Implement encryption, strengthen access controls, regular security audits, and then compliance monitoring. Very normal corrective actions were suggested. Let me ask you some questions. I'm typing the questions on the screen. Please try to answer. There are some certain questions over here. This is question number one. Do you know what is ICAP? Do you know what is CFSS for NBFCs? Yes, any idea? What is ICAP and what is CFSS for NBFCs? Recently, I had the interaction with some of the NBFCs and they were not sure about what is CFSS. Any idea? You may take a note. The CFSS is Core Financial Service Solutions. I repeat, CFSS is Core Financial Service Solutions. It's a kind of dashboard about loan management and portfolio management. I repeat, CFSS, Core Financial Service Solutions. So you have to prepare your dashboard on IT infrastructure, and the last date of implementing CFSS for NBFCs is 30th September 2025. Then other one is ICAP. It stands for Internal Capital Adequacy Assessment Process. I repeat, it stands for Internal Capital Adequacy Assessment Process. This ICAP assessment is mandatory for all those NBFCs which are falling into middle layer category or upper layer category. So if you have NBFCs who are having asset size of more than rupees 1,000 crores, ICAP is mandatory for them. And what I observed, that ICAP is not conducted by most of the NBFCs. So ICAP assessment, ICAP policy is required, CFSS dashboard needs to be prepared, and the last date is 30 September 2025. Let me discuss other case study now. Management of customer grievances. GHI Finance Limited, an NBFC with a customer base of 2 lakh received 5,000 customer complaints in FY 2324. The complaints primarily concerned delays in loan processing and errors in EMI calculations. A detailed internal audit found that 40%, that is 2,000 complaints, remained unresolved for over 30 days, contravening the RBI's Fair Practices Code. The unresolved complaints were associated with loans worth rupees 100 crores, affecting customer satisfaction and potentially leading to regulatory scrutiny. I don't know whether you are aware of this RBI's Fair Practice Code or not, but this code has many other principles to read. One of the major principles is proper management of customer grievances. And I believe this is one of the case study which is quite prominent as one of the non-compliance in most of the NBFCs having customer interface. So what were the issues identified here? Weak internal controls. The NBFC lacked a structured process for handling complaints, leading to backlog of unresolved issues. Non-compliance with RBI norms, failure to resolve customer grievances in timely manner violated the RBI's Fair Practices Code. So what were the suggestions made? Establish a grievance redressal mechanism, set up a centralized grievance redressal system with a dedicated team to ensure that all complaints are resolved in 30 days. This would have addressed the 2,000 unresolved complaints worth rupees 100 crores. Then is adopt RBI's Fair Practice Code, regular monitoring, customer communication, training and development. I would suggest when you go through this RBI Fair Practice Code regarding resolution of customer grievances, please also refer RBI Ombudsman Guidelines for NBFCs. So both will go hand in hand, that is RBI Fair Practice Code as well as RBI Ombudsman Guidelines. Case study number 5. Mismanagement of loan recovery process. JKL NBFC, which has a loan portfolio of rupees 1,500 crores, faced a significant rise in NPAs, that is non-performing assets, from 5% in FY 2223 to 12% in 2324, amounting to rupees 180 crores. The internal audit revealed that loan recovery process was poorly managed, with over 30% of recovery agents failing to follow up on delinquent accounts within the stipulated time frame. Additionally, it was found that no legal action was initiated for overdue accounts exceeding 180 days, contrary to company's internal policy and RBI guidelines. So in June 2019, one circular was issued for stressed assets and recovery thereof. That 180-day period is given over there. So this NBFC failed to follow this 180 days criteria. So what were the issues identified? Weak internal controls, inadequate monitoring of recovery agents, and failure to initiate legal action against delinquent borrowers led to a sharp increase in NPAs. Then is non-compliance with RBI norms. The failure to manage overdue accounts as per RBI guidelines contributed to deterioration of asset quality. For this RBI norm, you may refer June 2019 circular on stressed assets. So what were the observations? They are before you. What are the corrective actions? These are the corrective actions. And then monitoring of recovery agents. Implement a tracking system to monitor recovery agents' performance, ensuring follow-up on delinquent accounts. This could reduce NPAs by at least 3%, saving 45 crore rupees. Initiate legal actions. Enforce strict adherence to internal policies by initiating legal proceedings on accounts overdue for more than 180 days, potentially recovering 30 crore rupees. Improve communication. Establish regular communication between recovery teams and legal departments to streamline the recovery process. And lastly, periodic reviews. Conduct quarterly reviews of loan recovery process to ensure alignment with RBI norms and internal policies. Out of these 4 points, this point number 3 is very important. What was happening in this case? The finance team was having the communication link with recovery team, but finance team and recovery teams were not having any link with legal departments. So this kind of communication gap was persisting, and because of this communication gap, the recovery process was hampered. So please always keep in loop 3 parties: finance team, legal team, recovery team. This will ensure a proper follow-up action for recovery of the loans. Next case study about incorrect loan classification and provisioning. MNO Finance Limited, with a loan book of rupees 3,000 crores, misclassified a segment of loans worth rupees 200 crores as standard instead of substandard, which led to under provisioning by rupees 30 crores. The misclassification was identified during an RBI inspection, which also noted that NBFC had not revised its provisioning norms in line with the latest RBI circular. So this identification took place in RBI inspection, RBI supervisory inspection. So what were the issues identified? The misclassification of loans led to significant under-provisioning, exposing NBFC to potential financial instability, and there was a non-compliance with RBI norms regarding failure to update provisioning norms according to RBI guidelines, resulting in regulatory scrutiny. You must be knowing very recently RBI norms were revised regarding asset classification and provisioning. So those norms were not updated in the IT system by this NBFC. Then what are the corrective actions? Immediately reclassify the loans correctly and increase provisioning by 30 crores to cover potential losses. Then update provisioning policies, regularly update loan classification and provisioning policies in accordance with RBI norms. Regular internal audits, conduct monthly internal audits of loan classifications to ensure accurate reporting and compliance, preventing future discrepancies. And one common point again, train the finance team, because finance team is responsible primarily for this kind of provisioning and classification. Case study number 7, inadequate risk management in ALM, asset liability mismatch. So PKR Finance Limited, with total assets of rupees 2,500 crores, experienced liquidity issues due to significant asset liability mismatch. The NBFC had rupees 1,000 crores in short-term liabilities, but only 700 crores in liquid assets, resulting in 300 crore shortfall. In legal terminology, it is called as cumulative mismatch. The internal audit revealed that the company had not adequately hedged its interest rate risk and failed to maintain proper asset liability management framework as required by RBI guidelines. So what were the issues identified? Number 1, weak internal controls. The lack of robust ALM framework led to significant liquidity risk. And next, failure to comply with RBI norms, failure to manage interest rate risk and maintain an appropriate ALM framework violated RBI norms. Suggestions: develop a comprehensive ALM framework, that is, establish an ALM framework that aligns asset and liability maturities, reducing the rupees 300 crore liquidity gap, hedge interest rate risk, implement interest rate swaps or other hedging strategies to protect against fluctuations that could exacerbate the mismatch. Then is regular monitoring, conduct monthly reviews of ALM position to ensure adherence to the framework and compliance with RBI guidelines. Then you have to have some liquidity buffer, maintain a liquidity buffer of at least 200 crore rupees to manage the unexpected shortfalls. I believe you must be aware that RBI circular is there on asset liability management, where we also need to have ALCO committee. So this ALCO committee, asset liability committee, is required by those NBFCs who are having asset base of more than rupees 5,000 crores. Case study number 8, non-compliance in reporting to credit bureaus. For example, CERSAI. So question is, VWX Finance and NBFC with 1,200 crore rupees in outstanding loans was found to have delayed reporting borrower repayment status to credit bureaus by an average of 45 days instead of required 30 days. This delay resulted in inaccurate credit histories of over 2,000 borrowers, which could potentially affect their credit worthiness. The internal audit revealed that the delays were due to lack of automation in reporting process and inadequate oversight. So what were the deficiencies observed? Weak internal controls, delayed reporting led to inaccuracies in borrower credit histories, potentially harming their financial standing. And non-compliance with RBI norms, the delay in reporting contravened RBI guidelines, risking penalties and loss of reputation. So these were the deficiencies. Now corrective actions. So suggestions were made like automate reporting processes, implement an automated system to report borrower repayment status to credit bureaus within the required 30-day time frame. Enhance oversight, assign a dedicated team to monitor and ensure timely reporting, reducing delays that affect 2,000 borrowers, periodic audits, and customer communication were other suggestions made by us. Before I jump to the next discussion, I need to ask you a question. Whether NBFCs as financial creditors have any obligation under IBC vis-a-vis reporting about borrowers to any Regulatory Forum. Yes, any answer? IBC stands for Insolvency Bankruptcy Code. So what is your answer? Whether NBFCs are having any obligation under Insolvency Bankruptcy Code to report something about borrowers to any regulatory forum? Yes, any answer? No answer? And please bear in mind the words are financial creditors. Let me see the chat box. Some answer is there. Deepa ma'am says answer is yes. So please take a note. I must type on the screen also. When you go to Insolvency Bankruptcy Code, so what is the answer? We have section number 215. Section number 215 says financial creditors need to file information about loans being given, and where filing is required, filing need to be made to information utility, popularly called as IU. So in India, we have the utility, and it is www.nesl.co.in. You may search on the net. It could be GOV. I'm not that much able to recall now, but it is NESL. NESL stands for National E-Securities Limited. So you have to log into this website and update the information about the borrower. That is a mandatory requirement as per section number 215 of Insolvency Bankruptcy Code. So when you are going to do internal audit, also check whether NBFCs have complied with or not section 215 of Insolvency Bankruptcy Code. Go to the website of NESL, download the information being filed so that it could serve as adequate documentation as well. So I have covered RBI norms also at a macro level. Let me share with you certain observations which were made by RBI in recent actions. You may be aware, in past few months, several punitive actions have taken place against NBFCs. So I have compiled those punitive actions by RBI, whereby some of the NBFCs were thrown out of the business. Their license was cancelled also. So let me share with you some of those instances. So one of the Lucknow-based NBFC was there. It was into microfinance business, and RBI cancelled the certificate of registration of that NBFC. So what were the observations of RBI which led to cancellation of the license? Number one, failure to maintain minimum regulatory NOF, net on fund, and minimum capital adequacy ratio as stipulated by RBI for microfinance institution. Other discrepancy was delay of 7 months was observed in finalizing the balance sheet. There was a considerable delay in submission of supervisory returns. There are net cumulative negative mismatches, that is ALM mismatch, in various maturity buckets of 1 to 30 days in excess of prescribed threshold limits. And then lastly, the company failed to submit the required information sought by the RBI and refused to cooperate and produce books of accounts or other documents during the on-site inspection. And due to these discrepancies, what happened? The license was cancelled. Some of the other observations, where there were many NBFCs, when you will go to the RBI website, you may see the menu item press releases. Just click upon press releases section of RBI, and you will find the punitive actions against NBFCs that have taken place against such NBFCs of late. So what were the discrepancies? I have compiled here. Major three deficiencies were there. NBFCs charge interest on loans from dates prior to the dates of disbursal of these loans, which was contrary to the terms and conditions of loans communicated to customers. Other deficiency was the NBFCs failed to put into use a robust software to throw alerts when transactions were inconsistent with risk categorization and updated profile of customers as a part of effective identification and reporting of suspicious transactions. Then the NBFCs failed to implement fraud risk management system across all delivery channels. So these were some of the deficiencies, of which this number one is the top-notch deficiency, due to which punitive actions have taken place. So I must ask you one question over here before I move to the other clip. I will let us cover this clip first of all, then I will ask the question. Other deficiency notice was, this is the other deficiency noticed, failed to take prior written permission of RBI for change in management, resulting in change of more than 30% of its directors, excluding independent directors, warranting imposition of monetary penalty. I don't know how many of you are aware of this provision or not. So we have RBI norms which state that if other than independent directors, the directors are changed, the KMPs are changed, and this change has resulted in more than 30% change in the management, then you can do this thing only with written permission of RBI. Other contravention was the NBFCs failed to carry out risk categorization of certain customers. You have to categorize the customers into high risk category, medium risk category, low risk category. Then the NBFCs failed to ensure the loan agreements with borrowers clearly contain the features of co-lending arrangement and the roles and responsibilities of company and co-lending bank. You know very well, RBI has allowed NBFCs to go for co-lending arrangements. But if you are going into co-lending arrangement, the borrowers must be informed about the various features. But NBFCs failed over here. And this led to penalties imposition by the RBI on NBFCs. I have a small question for you. I am putting the question on the screen. This is the question. Suppose that ABC Private Limited is NBFC into gold loan business. Let us assume Mrs. X approached for a loan of rupees 50,000 by mortgaging her jewelry. Question is, what aspects you will check as internal auditor? Yes, any answer? So if gold loan is going to be granted to Mrs. X on mortgaging of this jewelry, what aspect you will check? What is the major aspect? Do you know what is LTV? LTV ratio? What is LTV ratio? Called as loan to value ratio. What is LTV ratio?
Sharon sir, one participant has raised his hands. Can you please unmute him?
Please, let us proceed. Meanwhile, other participants, if they want to try the answer for this question. So a demand of loan is there by the borrower, prospective borrower 50,000 rupees. So what the aspect internal auditor should check over here? Any answer? Deepa ma'am, will you like to try? Okay, let me make one more thing clear. Jewelry worth rupees, say 80,000. Any answer? Deepa ma'am says LTV is 80%, okay? Deepa ma'am, are you sure LTV is 80% or higher than that or smaller than that?
No, I'm not sure of that.
Okay. Okay, let us assume LTV is 80%. Then what are the aspects to be checked? Let me make the question much more interesting. So at present, what is the situation? Let me type on the screen. LTV is 75%. So now the question is, let us keep this question aside. Let us remove this question. So the question is now, shall this NBFC give rupees 60,000 of loan to Mrs. X, 75% multiplied by 80,000. Give rupees, I should rather correct it myself, 50,000 of loans to Mrs. X because its maximum permissible limit is rupees 60,000. Now, what is your answer? Can NBFC do this thing? Can NBFC say jewelry is worth rupees 80,000, LTV allowed is 75%, so 75% of 80,000 is 60,000, and the Mrs. X is demanding the loan of rupees 50,000 only, which is not exceeding 60,000, and hence NBFC can give the loan. Is this allowed? I got one answer in the question and answer box by Shri Devjit ji. LTV is the loan to value ratio. It should not be more than 75%. That is correct, sir. Now, having said that, that LTV should not be more than 75%. In this question, please tell me if on the basis of 75% of LTV, the maximum permissible limit is 60,000, can 50,000 rupees of loan be given? In this question, can you see as internal auditor any finer point? This is one of the contravention which is happening in plenty. Srinivasan sir, any idea? This is my last question. After this question, I will wrap up because I have covered my PPTs. I would be happy to answer your queries. But in this question, I need your inputs. Now, what is LTV saying? LTV says that you can give maximum 75% of loan on which value? Value of the gold. I repeat, value of the gold. In this jewelry, the component of gold will not be 100%. Are you getting my point? The component of gold is not 100%. So what you need to check as an internal auditor, whether the loan being given to Mrs. X is computed on LTV of 75% of the gold value or the jewelry value. If it is computed on the basis of jewelry value, it is a wrong practice. You have to do the fair valuation of gold out of that total jewelry value, and that gold value multiplied by 75% will give you the maximum permissible limit. Are you getting this point? Am I clear? Deepa ma'am, have you understood? What is the point here? Jewelry is worth rupees 80,000. But in that very jewelry, what is the component of gold embedded? So we have to segregate the gold component from the entire jewelry, and on that gold component, we will apply LTV ratio. LTV ratio shall not be applied on entire value of jewelry. LTV ratio is applied only on the value of gold. This is something very, very important. And what my experience had been that these companies who are into gold loan business, they are computing LTV ratio on entire jewelry. So we need to be very careful on this forefront. So from my side, this is the whole discussion because you were having no questions. So the time is still there. I would be happy to take up your questions, if any. Or I should rather ask a final question, clear or all clear? But I would suggest once you will get this PPT, please take this PPT as one of the checklist scenario because all these points are from real world. Nothing is hypothetical. Deepa ma'am, any question from your side?
No, Ji.
So you will say all clear?
All clear. All clear.
All clear.
All clear. Kamalji, if you can just add your email ID also
Yeah.
to the PPT before you send it to me for circulation.
So I will add the email ID here.
Yeah.
So this is my email ID, cakamalgarg@gmail.com. Should you have any queries in future, you can again write to me, and I do have the habit of replying the emails, so your emails will be responded.
So since there are no further questions, I think we can wind up the session.
Yeah.
Thank you so much, CA Kamalgar. The way you took the session, the question answer model, it was very easy for us to relate to the real world, but somewhere I think there was a little lack of preparedness from my end, especially. So I was not able to answer many of your questions, but next time you take a session, trust me, I'll be prepared. I know you'll catch me. On behalf of all the participants present here and on behalf of IIA Kochi Club and Madras chapter, I thank you for taking this wonderful session to us. And thank you so much for sharing the presentation with us so that we can go through it in detail. And then in case there are any queries, we will write to you. And thank you, dear participants, for participating in such numbers, good numbers, because we hardly got 2 days to circulate this poster. But in spite of which, we had a decent number of registrations and quite a few people have joined. And I also noticed that many people from Federal Bank has joined. So I think that very word of RBI, I think a few members from Federal Bank has also joined. It's a pleasure to see them. Thank you so much, each and every one of you participants for joining us.